Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on Lesson 8.6 of Unit 8, Price Action Trading. In this lesson, we're going to cover Fibonacci retracements. By the end of this video, you'll understand how to use Fibonacci levels to identify potential buy and sell zones in the market. Let's get into it. Fibonacci is a mathematical sequence that appears in nature, from the arrangement of leaves on a stem to the branching of trees. This sequence also appears reliably in financial markets, and that's what we're going to explore today. The Fibonacci sequence is a series of numbers where each number is the sum of the two preceding numbers, starting from 0 and 1. In the markets, after a strong move, price often pulls back before continuing the trend. This pullback is called a retracement. Think of it like a rubber band stretching and then snapping back. The retracement is the snapback part, where the price moves back in the opposite direction of the original move. There are specific levels that traders watch for retracements, and these are based on the Fibonacci sequence. The most important levels are 23.6%, 38.2%, 50%, 61.8%, and 78.6%. These levels are like magnets that attract price action, and they can help us identify potential buy and sell zones. To use Fibonacci in your trading, you'll need to drag the Fibonacci tool from the swing low to the swing high for an uptrend, or from the swing high to the swing low for a downtrend. This will give you the key levels that you can use to identify potential buy and sell zones. The golden ratio, 1.618, is considered the most important Fibonacci level. This level is like the holy grail of Fibonacci trading, and it's where price often reverses or continues the trend. Think of it like a pivot point where the market decides what to do next. Let's take a look at an example. Suppose the euro to US dollar currency pair rallies 200 pips and then pulls back to the 61.8% Fibonacci level. This could be a potential buy zone, as the price is likely to bounce off this level and continue the uptrend. When a Fibonacci level coincides with a support or resistance zone, it's like a double whammy for the price action. This is called confluence, and it's a very strong level that's likely to hold. Think of it like a wall that the price can't break through easily. There's also a rule that says if the price retraces more than 78.6% of the original move, the trend may be reversing entirely. This is like a warning sign that the market is changing direction, and you should be careful not to get caught on the wrong side of the trade. Now, I want you to practice drawing Fibonacci levels on 3 recent major moves on the euro to US dollar currency pair. Mark the key levels and see how the price action reacts to them. This will help you get a feel for how Fibonacci works in real-time trading. That is everything for Lesson 8.6, Fibonacci retracements. If this helped you, smash that like button and subscribe to Tick to Loot so you never miss a lesson. Drop a comment below. What was the most useful thing you learned today? See you in the next lesson, looters. Keep turning those ticks into treasure.